The latest Westpac Consumer Sentiment survey has just been released, and while there are some faint glimmers of hope, particularly around family finances and labour markets, it's still a fairly bleak read. The headline index rose 2.9% in the month, but at just 82, it's still nearly 20 points below its long-run average in deep pessimistic territory. And there are some other factors overshadowing this slight improvement in the month. In particular, consumers are becoming more wary about the potential for further interest rate rises. Amongst those surveyed after the RBA decision, over 60% expect interest rates to move higher over the next 12 months, mortgage interest rates. That compares to a little under 50% post the RBA decision in September. That undoubtedly comes back to some signs from monthly indicators that inflation is still running too high. The August monthly CPI indicator ticking back above 5% for annual inflation. That said, the shift in interest rate expectations was a little bit nuanced. It looks to be coming mainly from the deposit belt rather than the mortgage belt. So older age groups and retirees seem to be driving that expectation of higher interest rates over the next 12 months rather than households with a mortgage. Other aspects of the survey continue to show a clear tension in the housing market around house prices and affordability. Assessments of time to buy are still very weak, albeit improving slightly in the October month, and price expectations becoming increasingly bullish. It looks like we'll continue to see this pattern of sustained price increases but relatively low volumes there. Around the labour market, we did see a slight improvement in unemployment expectations. The general picture here is still quite relatively positive compared to the wider consumer sentiment picture. It's consistent with unemployment holding steady over the next 12 months rather than rising from here, but still fairly flat overall. So all up, a fairly sombre read, given we're now moving into the pre-Christmas sales season. Suggests that consumers will still be watching their cash pretty carefully, cutting back on spending in a per capita sense, and it looks like more of the same near term. Whether we get an improvement beyond here, it's hard to say. It's really still going to rely on whether the cost of living pressures that are bearing down heavily on the consumer start to abate as we move into the new year. So what does this mean for the RBA? Well, today's update really emphasises that the continued weakness in the consumer sector is going to carry through to the end of this year, emphasising the main negative that the RBA is trying to grapple with. It will be concerned with recent inflation outcomes. Really what's going to be important is the September quarter CPI update, which gives the full rundown on inflation and will be out just before the November policy meeting. The details are going to be very important with that update for the RBA, and those next couple of meetings could be quite finely balanced. Overall, we expect the RBA to leave rates on hold, but it's a pretty interesting couple of months looming.